What's up, YouTube and my family at Torum.com? Join me on Torum.com, link below in the description. So today we're going to get back into a new video. We're going to talk a little bit more about the psychology of trading, what really moves the market. We're going to talk about the fear and greed index, uh, which is not really the true thing that's going on. We're going to talk about different aspects of trading. Mostly right now, I want to get into the fear and greed index. Reason I want to go there is because people have it wrong. People are teaching it wrong. It's not fear and it's not greed. It's pain and it's pleasure. Think about it from a psychological standpoint. When you fear something, there are two main reactions: fight or flight. It's not fear because when you get out of that trade, you don't run from that coin and never trade it again. You either hop back on it at another time when you feel more comfortable, or you continue, you make an adjustment and you continue on where you got out. It's like, okay, I did that wrong, make an adjustment, boom, I'm right back in it. So that's not fear. When you fear something, you don't hop right back on it. You don't hop right back into it. You run from it. You usually keep running. So that's not fear. That's pain. Okay? And this is why you want it to stop instantly. Because you're feeling pain, financial pain. And you want it to stop. Just like with all pain. If somebody jabs you with a pen, what do? You immediately brush that away, grab your arm. You want that pain to stop instantly. That carries over into your trading. So it's not fear. So let's talk about the other half of that. Greed. It's also not greed. Why is it not greed? Because when you're winning, the same chemicals that get released into your brain when you're having sex happen when you're winning and trading. It's pleasure. And like all humans, we never want the pleasure to end. We want it to keep on going and going and going and going. And that, what does that lead to in trading? It leads to you staying in the trade longer than you should, which can be mistaken for greed. And this is why they have that part wrong. It's pleasure. You just want the pleasure to continue. You're not thinking, oh, I gotta have it all. I gotta have it all. No, that's not how most traders are thinking. And if you are, get help. Seriously. You need some. But most traders aren't thinking, I gotta have it all. I gotta squeeze every dollar out of this trade. They're not thinking like that. They're feeling pleasure. They want the pleasure to continue. So they stay in the trade longer than they should. And it winds up going against them at some point. And this is why it's mistaken for greed. So instead of the fear and greed index, you actually have the pleasure and pain index, because that's how you actually react to winning and losing, pleasurably and painfully. That's what it feels like. So that's how you react to it. So knowing this, knowing that it's not actually fear and it's not actually greed, you can adjust your mindset. You know that, okay, I'm feeling pain. I want to get out. Is it actually time to get out? Reassess your analysis at that point. When you're feeling the pain, when you're feeling the pleasure, do the same thing. It's like, this feels really good. That means that it's time to check. It's time to reassess. Yes, it feels really good. Yes, you want it to go on. check your candlesticks, check your charts, check whatever it is you use to make your trades, and make sure that things aren't about to reverse on you. Because you know the saying, the trend is your friend that will turn on you in the end. So we know that that pleasure is not going to last forever. We know that it's going to turn against us at some point. So we have to be on top of that ride up to the top. Because when it starts to turn, you want to get out. But you don't want to get out too early. So you want to make sure that you have some type of confirmation that it's time to get out. And that way we eliminate the so-called fear and greed index to a major degree. So now let's get on to the chart. Yesterday, talked about trigger points, where they are, what they do. Talked about dollar cost averaging, where this zone is, and how it works. Talked about consolidations. Oh, that's my alarm. Sorry about that, guys. It's actually time for me to eat. Anyway, so we talked about consolidations, consolidation lines, consolidation boxes. So now today I'm going to show you how to draw a consolidation line and consolidation box back here. Actually, no. Let's do it right here on this consolidation. Okay, let's expand that a little, get it bigger so I can see it clearer. All right. So I like to draw the boxes from the beginning of the box, from a doji, a shooting star, hammer, something like that. I like to end on the same, preferably a doji. When it can be done, it can't always be done like that, but that's what I like to do. It's just easier for me, so it's a personal preference, not something that is necessary for this particular style of analysis. So right here is approximately where we would start the box. Now, how boxes work, when you want to draw them, you want to start at the top of the movement, okay, which is about right there, and you want to go to the bottom of the movement, which is about right there. Then drag your box across, and let's find where it stops. Stops all the way over here, and that's where they start to untangle. So here we go, bottom of the box, top of the box. There, we got the box done. Now we want to put a horizontal line through the middle of the box. Excuse me. So what I usually do here is I grab a horizontal ray. I'll take it. That should be right about the middle, right there. Boom. Check. And yep, pretty much on point. So why did I do that? Well, let's see what that horizontal line does. As you can see, the price is playing all across this line, actually bringing up another consolidation point right here. So what we would do in charting this is we would draw another consolidation box around this consolidation as well, and another line. Now this can make your charts get pretty cluttered pretty quickly, especially with market going in and out of consolidations like it has been doing recently. There'd be a lot of lines across here. So to reduce some of the noise, you would take the line and you would run it right here to where it gets stopped by this candle. Then you would draw your new consolidation box around here and a new line, probably a little bit higher, about right here, looks like to me, would proceed. So let's go ahead and make the new consolidation box. I'll get into the explanation of why we're doing this as soon as I'm done doing it. Okay, next consolidation box. Top of the box is approximately right here. About right there, the beginning of the box. Right in there. So let's take it to the top, bottom. Looks to be right there. That's the lowest candlestick wick. And it goes all the way over to right there. Boom. And we can see where that next line is going to be, about right there. So let's get it, put it on it. Boom. Again, pretty much dead center. So moving across the board here, we see that the price is currently broken through two consolidation lines. It hasn't bounced off either. It's headed up towards the top here. Now, way back here, I can guarantee you that there's a consolidation line had I drawn the box that's going across right around in this area right here. If it's not a consolidation, then it'll most likely be a Fibonacci line, one or the other. Most likely an old consolidation line. That's usually what makes patterns like this kind of just like stall out, appear to stall out of nowhere, out of nothing. It's an old consolidation line that you currently can't see because it either wasn't charted or could have missed it. That didn't actually happen. I just started the chart new, so stuff from way back when isn't on there. I actually started the chart from right here. Okay, it would have been right in this area right here, leading up to the consolidation. And then this is where I decided to start making videos because the chart was pretty much clean there. So we've got our two consolidation boxes. And now we're going to go into how they're used and why they're important. Right now, there's not really a whole lot that I can show you right here because, well, the most important thing to know about the consolidation boxes and the lines are they help you with your entry and exit points. But before you get into that, you have to know the overall prevailing direction of the market. Be it bearish, bullish, it doesn't matter. You just have to know the overall prevailing direction of the market. That's important because let's say, for instance, that it happens to be bullish, like it appears to be right now. So anything, so when the price reverses itself and breaks below the consolidation line, that would be an entry point right there. Because again, the overall direction of the market is bullish. So we're expecting it to turn around. It's absolutely necessary to know the prevailing direction of the market because you're trading with the trend. You're always trading in trend. You're never trading in expansion. You're never trading in consolidation. It's always in the trend. So you absolutely have to know which direction the trend is in. Like right now, it appears, like I said, it appears to be bullish, but that might not be the case. Okay. The real way to know is like I'm on the hour chart. Let's go and look at the weekly. Spread that out a little bit there. Weekly chart says, hey, bullish. So it was bearish last week. It's turned bullish this week. That means that we could be in for Mr. Toad's wild ride here. Oops. Go back over here to the hour chart. So for the week, we've gone bullish. However, indicator down here, as it's coming up to this, says that we're going to turn around. If it goes even higher, it's going to be a sharper spike downward. So everything that we're gaining right here, right now, could be lost. I know this looks like it's messing with the prediction that I made yesterday, but it's not. Like I said, when the MACD hits this furthest line up here, it'll most likely turn around. If it passes it, it's definitely going to turn around, and it's definitely going to be a sharp downward turn. No ifs, no ands, no buts about that. Let's look back over here. When it passed it right here, you see the downward turn. It was pretty sharp. It took back everything that was gained right here. Boom, it hit the line up here on the MACD, turned it around, took everything back. Okay, so we have another spike going on like that, where it's just past the MACD line right here. The what is that? That's the positive 100 line right there. So, and it's about the same place where it turned around last time. Again, I like patterns. I like history. Looks like it's going to repeat itself and do the same thing. See the separation happening here. Same thing going on there. That's also a sign that it's going to reverse itself. The wider the gap, the quicker it usually reverses. Also, the harder it spikes downward. Let's look back over here. Bring this back up here. Where we spiked. Okay. Just barely peeked up over above that. And took us for like a lazy ride downward. Okay. There has to be another better example, but I'd have to go further back. Not going to do that right now. Let's stay right here. So like I was saying, when the price returns down, if we've confirmed that the overall direction is bullish, we wait for it to pass under the consolidation line for an entry point. Okay. Like on this first line here, this would have been an entry point. Why? Actually, this would have been an entry point right here too. Why? Because it passed the consolidation line. It went away, moved away, boom, comes back down, passes the line, entry point. Okay, comes back up, goes into consolidation. This is where we would put a pause on the trade. We're not getting in and out of anything right here. And then it makes a terrible dip back below. This would be another entry point for that first consolidation. Again, only if you confirmed that the overall market direction is bullish. Okay, so we got a new box here, new consolidation line. Everything is broken below the new consolidation line in the new box. So entry here, entry here, entry here, entry here, entry here. Then you have your run, and this looks like it's pretty much the top. I'd be thinking about getting out right now. Would have made depending on what you risked, would have made a pretty substantial return. Looking on this little bit of run right here. Like I said, this is about to curve downward. You can already see it curving downward. Okay, it's beginning to make its move in the opposite direction. So yeah, this is the height. This is where I'd be looking to get out. If not there, then definitely here or right before we get there, like in this area right here, somewhere in between the thicker and the thinner red line on the MACD is where I'd be looking to exit. So now, according to my prediction yesterday, this pattern right here will probably play out to a degree, even up to this point. That, this, we may already be over here, be honest. And we're about ready to turn around and get this downward pattern. Depending on how much higher it goes, all of this gain can be lost. And this is why you want to look to get out when you see it peaking up here. You want to look to get out because most likely when it's sharp, with a sharp spike downward, just like over here where it wiped out all the gains it made, same exact thing could happen right here. Same exact thing, just like it did right here. Spiked up, wiped out. Spiked up, wiped out. Don't be surprised when it happens, is my final thought on that. Be prepared for it. It's actually set up there on the chart for it. So it is a possibility. Sorry, guys. I got to cut this one short. Got an appointment that I forgot all about. Uh, just popped up on my phone. Anyway, until next time, guys, this is the Dark Sage signing out.